Kitco News special coverage of Masari's annual Mainnet Summit is brought to you by Oasis Pro.
The Fed holds steady on rates for now as investors revisit the uncertainty surrounding tighter credit. Just how badly are increasing borrowing costs squeezing consumers, businesses, and investment plans? I'm Matt Nesto with Kitco News here on the sidelines of the Mainnet conference, and here to join me to answer that trillion-dollar question and more is Max Boonen. He is the founder of PVO1, which, as you explained to me, is putting bonds on the blockchain. Also a former fixed income trader and economic watcher at Goldman Sachs. Great to have you on, Max.
Thanks for having me.
So let's just talk about the Fed today. It was expected, markets sell off a little bit. What are your observations here today, and how badly are businesses, consumers, and investment plans being affected by rising borrowing costs?
So the main decision and the subsequent conference was a bit more hawkish than anticipated. So you see the dot plot of expected future rates by the governors moved a little bit higher. And so that the market wasn't entirely expecting. But the justification is that the US economy is doing well, that inflation hasn't entirely been tamed yet, and so that a little bit more needs to be done. So telegraphing perhaps a couple more hikes and also fewer rate decreases, rate cuts in the next 3 years. And that led the rates market to sell off, as well as some risk assets.
When I look at a chart of the Fed's benchmark rate, it seems like they hold longer after easing cycles before they start tightening, and then they reverse direction after tightening cycles to cutting, to easing, very, very quickly. Will we see that again? I mean, they're looking for what? There maybe one more rate increase this year, and maybe two next year at some time. That's a pretty quick turnaround.
I think there's a level of momentum in the decisions, and oftentimes you find that central bankers tend to, cut for too long or hike too much or for too long. It's a little bit difficult to fold them because they only have the models that they have, which are imperfect. You do find that the market is often a little bit more accurate because just more people are looking at this, right? And in fact, that's why a yield curve inversion has been so often the hallmark of a coming crisis, of a coming reduction in economic activity. So the Fed is one thing, but the rates market is another. I think what we have now, though, is, in my personal view, the market has been wrong. The market has been wrong in expecting for so long rate cuts that there would be a negative turn to growth and that the Fed would change tack, and that's not been the case. In fact, one of the best trade of the past, call it 3 to 6 months, has been, steepeners, especially around the front end, up to 5 years, let's say. And so the market has been proven wrong by the Fed. They also say, don't fight the Fed, and perhaps that's the dynamic in which we are. Oftentimes the market's more right than the central bankers, but this time around, clearly the market has been wrong-footed.
So there's 2 more meetings left this year. The Halloween, November 1st one, that'll be full of all kinds of puns in the press. I can't wait for that. And then the mid-December kind of meeting as well. So, whether we see the expected hike or not, I guess remains to be seen. But certainly the inflation data and that calendar will be rolling. You already mentioned inflation. Do you feel like inflation, GDP, jobs data, or straight, rates and consumer purchasing patterns, do you feel like any one of those is maybe the best barometer to look at in the short term here?
Well, one of the problems we have with the measures of inflation is that, and that's being discussed on the way up, and I suppose going to be discussed on the way down, is that one of the big sources of inflation is asset price inflation, the price of houses, the price of financial assets, but those are not part of the traditional inflation measures. And on the way up, everyone was happy that whilst inflation in goods wasn't so high, there was a lot of asset price inflation because everyone's got a home or a 401k was happy. And on the way down, markets are taking a breather, but at the same time, that doesn't mean that inflation in goods is moving together with that. And so I think people are a little bit surprised perhaps that we have an easing in asset prices, but the Fed is not moving. But it makes perfect sense because the bubble that the Fed created in the past 10 years was also the result of asset price inflation because they were looking through that to only consider the price of goods and services. And now we've got the opposite dynamic. And I think it stands to reason that, yes, the Fed is not going to stop just because asset prices are going down. And we used to talk of the Greenspan put. And I don't, maybe that was just a Greenspan thing. It doesn't mean that future governors have to play by the same rules.
Yeah. In his commentary, Chairman Powell had said that a soft landing is still a, quote, plausible outcome. I mean, are you buying that? Or maybe we'll buy the Brooklyn Bridge. Is a soft landing plausible? Does it even really matter? Are we splitting hairs here? Because sometimes the recessionary data is going to come 6 months after the fact. We'll have moved on and we'll be looking 6 months past that.
I think we may be splitting hairs because some of the details here are quite minute.
Yes.
Right. I don't think we're not talking about stagflation like in the 70s.
Right.
We live in. I mean, the economy at the end of the day is either doing rather well, quite well, or okay. But we're not talking about a proper crisis like 2008, and that's in a context where some of the macro data outside of the US has been very soft. You look at what's happening in China, that doesn't seem to be seeping through to the US. In fact, some might say that it might be in some ways a positive when it comes to reshoring and things like that. So we'll have to have a look at that. But indeed, I feel like we're splitting hair a little bit. But if we couldn't split hairs, then I suppose lots of people in the fixed income market would find themselves out of a job.
Yeah, it's interesting too because it could be only minuscule, but ultimately in the land of bar charts, it's either above the line or below the line, red or green, and there lies the difference. So I guess it's important to some. Just looking at the Fed statement a little bit, some things, it says the U.S. banking system is sound and resilient. We kind of got through that. It looks like that was a short-term contained crisis. So that's, the feel good. And then, the statement goes on to say tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation, finishing up with the extent of these effects remains uncertain.
I would agree with that. And I think one of the big uncertainties, in my opinion, is that, to me, the impact of higher rates hasn't seeped through entirely into the housing market. Mortgage rates are really high now in the US. There's been some easing in prices, but just intuitively, I feel like there's more to come. And what remains to be seen, and to me, a lot of the uncertainty circles around the fact that we don't know yet the extent of the wealth effect on consumer spending. When you start to understand that your house is worth a lot less than it used to, does that affect your spending decision? We're also coming out of a period of intense fiscal stimulus in the pandemic, and I wonder if the end of stimulus plus the wealth effect, I wonder how that's going to play out in terms of consumer spending and the impact on growth that has.
Right. So do you have a favored barometer? I mean, the Fed is saying the committee remains highly attentive to inflation risks. That's the one they mentioned. Inflation's pretty broad. Is there something, a better thing to look at that's, more relevant to you, your clients, your businesses?
Well, in general, I think that if you look at forward inflation swaps, is typically what some people look at when it comes to understanding the inflation expectations of institutions. Now, I think that the way that the general population looks at inflation has more to do with the inflation that they see in shops, for instance, right? And to me, how that really plays out is how people view increasing prices as compared to wage growth and what it means in terms of real wage growth, as well as the impact on interest rates that has on their spending versus savings decisions. And I also come from the crypto market, and I think that's one of the big drivers of crypto prices is that when rates go from 0 to 5%, people start to wonder, all right, does it really make sense when I can get 5% for sure in the bank to go buy those risky assets like Bitcoin and Ethereum, even though the institutional market as a whole might be saying, hold on a second, those rates are quite temporary. If you look at, 2-year forward rates, we're expecting cuts. And so perhaps you should look through that gyration in the rates markets. But I don't think that's what the general population they look at. I think they look more at the short-term rates and where they stand today.
So if you look at your new business, PVO1, you're putting bonds on the blockchain. Does Bitcoin even matter to you? The price of Bitcoin to that business? I mean, of course it matters.
Not much. It matters not for the assets that we create for the bonds, because very few bonds would be denominated in Bitcoin. I view Bitcoin as a currency like any other, but it would make sense only for very few players to borrow directly in Bitcoin. Now, the fact of the matter is that the adoption of blockchain bonds is going to be happening first and foremost in the crypto market with native crypto players. And so the gyration of the crypto market as a whole and the impact that's got on volumes and on everyone's business model obviously has an impact on their propensity to borrow, on the propensity of investors to invest in crypto credits. And so I think that's the second order effect. If Bitcoin were to go to zero, I think there would be few takers for blockchain bonds because TradFi institutions are clearly not there yet. So it does have a secondary impact on my prospects.
Secondary impact.
Yes.
Yeah. It's interesting too because if you think about how these institutions are investing, and you think about the choices that they have, when the rates are moving in the U.S. and globally for that matter, and you're traveling a lot, it's a much more complicated decision in terms of how comfortable you are with the asset class to begin with. Like you had mentioned, the investors that are already involved in crypto are going to be the ones that are going to look at putting blockchain bonds on the blockchain because they're already there. And so I guess my question is more on a really global macro rather than a U.S. macro basis in terms of, are you seeing any nuances between these institutions, U.S. or North America, and say Europe or even Asia?
So the geographical split in terms of the willingness of investors, of institutions to touch the blockchain when it comes to fixed income. Yes, very much so, because it's not a secret now that the regulatory environment in the US is quite difficult. Whereas other jurisdictions like the EU, in Asia, Singapore, are really making headway when it comes to the adoption of blockchain technology, when it comes to traditional assets like bonds. And so I see, when you go to conferences like here, there's quite a bit of excitement around Europe and Asia, much more so than around the US. So I think that this goes in ebbs and flows, and at the moment it's the time of Europe and Asia to shine in the blockchain context.
I've heard more than one person tell me that the U.S. is missing an opportunity domestically to lead at its own risk.
I would echo that sentiment, and what's playing in favor, what's good for the U.S. is that it's got the biggest market. It's got the biggest financial market of all those major jurisdictions. And so people still want to go and innovate there. But you have to look at the downsides. And I feel like now we're at a point where the downsides of trying to make it work in the US market are so great that they essentially negate the effect of it being the biggest market of all. And so I think that's indeed quite a missed opportunity, because other than that, the US market, it's got everything going for it, right? Like Asia, Singapore should be a bit player in the crypto context, and that's what's telling me really that the fact that so many players are giving up, abandoning their US expansion plans, or you're even seeing companies such as Genesis Global Trading, a erstwhile very clear mainstay of the crypto market, shutting down US operations first, even though they had expensive regulatory licenses there. That's a really negative sign, and that should, I hope, seep through to lawmakers in the US so that they can also update the regulatory regime to bring economic activity in the crypto context back into the market in the US.
Cool. Max, any other thoughts or observations on your mind here today that we didn't discuss?
I think the crypto markets remain soft. Bitcoin didn't move so much, just like less than 0.5%, I think, on the back of the Fed decision. So hopes that the crypto crunch would last only a year, I think were proved not to be correct. And so I think we might be in for a longer crypto winter than people are expecting, perhaps. But that's part of the game. You can't force the market to be bullion. But I do hope that in the next 24 months rather than 12 months, we have another cycle that proves to be very positive for the industry.
Cool. Do you think it's going to be a Bitcoin-led cycle or something different?
Bitcoin remains the tide that lifts all boats in crypto, in my view.
Yeah, is that going to last? I've heard people say, it's the Model A Ford of cryptocurrencies, that it's dated.
I would say that although different cryptocurrencies have different features that are more salient, Ethereum has the programmability, that's quite good. So whenever we talk of, fixed income on the blockchain, everyone gets excited about Ethereum. The salient feature of Bitcoin is that censorship resistance, that link to controlling your own finances, which I think after the 2008 crisis is a theme that's not going away. When the Fed was created in the US, the gold was seized in the US here. That was a little bit traumatic at the time. But after 30, 40, 50 years and a world war, that was not on the back of everyone's mind anymore. And I feel like we've got that team has come back and is going to be with us probably for another good decade, I think, before people start forgetting about it. So until that's the case, I think that that feature of Bitcoin, that your Bitcoin can't be taken away from you that easily, I think that's going to remain a theme, especially in a context of the governments having become over-indebted, which was completely fine when rates were 0%. In fact, I think they should have borrowed more. But the pendulum is swinging in the other direction now. And the question is going to be, how do we pay for the cost of the pandemic, for the fact that rates are going back up? And I think there will be questions that are going to verge towards asset confiscation. And that's going to make the censorship resistance, the fact that we can't take your Bitcoins that easily, quite a theme in the next decade.
Awesome. Well, we'll leave it there for this time, Max, but thanks so much for coming on. I appreciate it. Max is the founder of PBO1. Good luck putting the bonds on the blockchain, and we hope to have you back. For Kitco News, I'm Matt Nesto.
Kitco News special coverage of Messari's annual Mainnet Summit is brought to you by Oasis Pro.